Hi, my name's Troy Smith. I'm a Senior Technical and Regulatory Change Manager. I'm here today to talk to you about the Federal Budget 2020 announcements. Before we even start, I want to let you know that there is a general advice warning attached to this presentation. Everything that I tell you today is general advice, not personal advice. I'm not taking into account your financial needs, your objectives, or your circumstances. So what was in this year's budget? Well, there were big tax cuts that were brought forward. There were lots of jobs programs. There were business tax incentives. The government has done really modest changes to superannuation, and there's been a little bit of social security cash splash announcements. But what we need to remember with this year's federal budget is it was delivered in the middle of the coronavirus pandemic, and it's really shaped what we've got this time. Federal budget proposals are merely just proposals. Until they're legislated, you can't rely upon them. So what you need to be aware is the final form of what we receive might be slightly different to what we talk about today. Okay, let's talk about the big ticket items. The government has brought forward some personal tax cuts that were due to commence on the 1st of July 2022 and now are proposed to commence on the 1st of July 2020. Now, in those changes are amendments to the income tax brackets, amendments to tax offsets, and a whole bunch of other changes. But rather than go through those detail, I'm going to hit straight to the important parts. What does it mean for you? I've got on the screen for you a table which lists estimations of income tax brackets, estimations of how much the current taxation would be, what the proposed taxation would be, and more importantly, what are the tax savings that we expect. So cast your eyes down the screen and look at where your taxable income would be. Let me give you an example of how to read it. So if I was on an income of $100,000, the current tax payable is around about $25,000. If the government proposals get through, then the proposed taxation would be around about $24,000 and I'd get about $1,500 as a tax saving. So, okay, that's good. We're really happy to see those tax savings come through. And what are you supposed to do with them? The government wants you to spend them. If you spend the money, it goes back into the economy, it recirculates, and it gets us kick-started to recover from the economic impact of the coronavirus. So let's talk about some of the tax changes that the government proposes for business. The first one is the Carryback tax loss. Now, this is a complex measure. You're going to need to speak to your accountant about it. But the way that it works is eligible businesses are able to look back in previous financial years from around about the financial year 2019-2020. They're going to be able to look back at any tax losses and offset those against any taxation profits that have been occurred after that date. It's a really interesting measure. It's a complex measure, but what it means is that businesses that had a tax loss in one year can then offset that potentially against some profits they may have generated and be eligible for a tax refund. So once again, what the government's trying to do is to put money back in businesses' pockets so they can go out and buy more assets, they can employ more people, and we can get the economy kick-started again. Another measure that the government's proposing to introduce is the capital asset expenditure. And this measure enables companies to go out, eligible companies to go out and purchase new assets and completely claim those as a tax deduction. Normally what would happen are these companies would purchase an asset and depreciate those over a number of years. So by allowing a full deduction, they're able to reduce potentially the taxation profit that they would report through to the ATO. The idea behind this measure is to incentivize businesses to go out and purchase, to refurbish the capital that they have, to make them more efficient, but also to incentivize them to spend more money in the economy. It's another really interesting measure, and if you're running your own business, it's one that you should talk to your tax agent about. The next measure that the government's proposing is a CGT exemption for granny flat arrangements. Now, some of you might be surprised that capital gains tax even applied for a granny flat arrangement, and it dates back to a really old ATO ruling that says if you create a granny flat arrangement, that a capital gains tax event has been triggered. So we're really happy to see that the government is getting rid of that measure. What it means is that people will be encouraged to formalise granny flat arrangements. And that's a great thing, because what we think that will do is reduce any incidents of elder abuse. What it means is that anyone who's considering entering into a granny flat arrangement will have conversations about what happens if things go poorly. What happens if they need to exit the arrangement? So we're really happy to see this measure get proposed, and we hope that it comes through. The JobMaker program that the government proposes to introduce has a number of different components. And what I'm going to do is talk to you about 3 or 4 of the really big ticket items. So the first one is the hiring credit program. And what it enables to do is eligible employers are able to receive a cash payment for each additional eligible employee. The way that it works, those employers need to put a new person on. They need to increase their head count. And if they're able to do that by a certain date, then they can receive a cash payment for those eligible employees. The way that it works is the cash payment that they receive is based upon the age of the eligible employee. Let me go through some of those details with you. If the eligible employee is between 16 and 29, then they'll get $200 per week. If the eligible employee is between 30 and 35, then the amount the employer will get will be $100 per week. If the eligible employee is over 35, then I'm afraid they don't get anything at all. And the program's limited. It's limited for 12 months. Let's have a look at the definition of an eligible employee. So they've got to be between 16 and 35 years of age. They need to have worked for at least 20 paid hours for that employer. They need to start work between the 7th of October 2020 and between the 6th of October 2021, and they need to have been in receipt of certain social security payments before they start working. So those payments are the job seeker payment, youth allowance, or parenting payment. If they can tick off those provisions, then they meet the definition of an eligible employee, and potentially that employer will receive a payment. And what we hope is that that will incentivize employers to put new employees onto their books. The next JobMaker program that I'll talk to you about is about boosting apprenticeships and a wage subsidy that applies for that measure. So this one will commence on the 5th of October 2020 and will wrap up on the 30th of September 2021. Eligible businesses will be reimbursed up to 50% of an apprentice or trainee's wage. Now, there's some limits on those amounts as well. It'll be capped at $7,000 per quarter, and it will be only available for up to 100,000 places. So we've got to wait for this measure to be legislated before we understand how it works. I really suggest that you keep your eyes on the details of this one. I think it could be a really interesting one to see how it plays out. The next JobMaker measure that the government is introducing is designed to drive jobs through housing, and it's actually an extension of an existing measure. The existing measure is the First Home Loan Deposit Scheme, which was introduced last year. And the way the scheme works are first home purchasers who had a small deposit, at least 5%, but probably less than 10%, previously had to get lender's mortgage insurance. And the way this scheme works is they could apply for access to the scheme, and if they got in, then the government would guarantee that they wouldn't need to apply for lender's mortgage insurance, but they still had to have at least 5% deposit to buy their first home. This scheme was really limited. They only offered 10,000 places, and I think as at today, almost all of those places have been exhausted. So what the government has proposed in this year's budget is to add an additional 10,000 places to that scheme. It's a good measure. It's one that should enable more first home purchasers to get into the home market, and importantly, it should drive that money back into the economy and incentivise more people to higher jobs in the economy. The next measure I want to talk to you about is super fund stapling. So at the moment, when employees don't choose their own super fund, they're allocated an employer's default super fund. But the government wants to change that. What they're proposing is from the 1st of July 2020, if the employee has a super fund, it stays with them when they change employers. So what it means is the fund is stapled to them. The employer must contribute to that existing fund if there's no direction provided by the employee. That said, the employee can still change to a different fund at any time, and that really relates to the current and existing measures that we have under Super Choice. The next measure I'm going to talk to you about is the Your Super Comparison Tool. This is a measure that the government proposes to commence from the 1st of July 2021. And it will enable you to jump online and look at an interactive online tool that will be developed by the ATO, and the tool will compare the investment returns and the fees for MySuper products. You'll be able to jump online and look at a table and see which funds cost the most and which funds are providing the best returns. The next measure I'm going to talk to you about is the benchmarking of super fund returns by APRA. This is a brand new measure that the government proposes commences from the 1st of July 2021, and the first round of reporting will occur on the 1st of October 2021. The way it's going to work is super funds are going to have to report their returns. They'll be benchmarked against other super funds. Now, if a super fund is determined as underreporting, they're going to need to report that to members. If the super fund underreports for a second year, then they may not be able to receive applications for new members. So this could be a really big change to the industry, and I suggest you watch this space. The next measure that I'll talk to you about are cash payments to eligible Social Security recipients. The government proposes that there'll be 2 cash payments of $250 made to Social Security recipients. The cash payments are expected to be paid in November 2020 and in 2021. I'm not going to go through the list of eligible recipients because they're on your screen and you can read them. The next proposal that I'm going to talk to you about is in relation to home care. If you don't know much about home care, this is how it works. For an elderly person who's eligible to receive care and wants to receive that care at home rather than entering into a residential care facility, they can get access to subsidised care, but the level of care that they receive might be limited. The problem here is it's actually really expensive to provide care at home. So what the government does is it funds a certain number of places, but unfortunately there's over 100,000 people that are waiting to get access to care. The government's looking to close that gap partially by adding an additional 23,000 places. I think that we need to watch this measure really carefully and check the legislation to see what the time frame will be that we get access to those additional 23,000 places. The next measure that I'll talk to you about is around extending the mobility allowance relief. And the way that this works is it allows individuals with a disability who can't get access to public transport to receive an allowance when they're travelling to work, they're looking to travel for work, or they're looking to travel for study. It often requires that there's a minimum amount of hours of volunteering activity attached to it, and these measures, or this particular measure, was extended in relation to COVID-19. The government's going to extend the relief measure related to this up until the 31st of December 2020. Okay folks, we're on the home run stretch. Let's go through the summary. So this year's federal budget was underpinned by the government's intention to restart economic growth. And what did they do? They introduced a couple of really important measures. Number one, bringing forward tax cuts for individuals. The government wants money back in people's pockets so they can get out there and spend and restart the economy. Number two, the government introduced a range of tax incentives for business. They want business to go out there, refurbish their capital, and get people back onto their books. Number three, they've announced a couple of cash payments for eligible Social Security recipients. I hope there's been some detail for you in today's presentation. If you've got any questions, have a chat to your financial advisor.